Hey, it's Rob Weinberg, and on this channel, we empower people to take control of their futures through expert mortgage, financial, and real estate strategies. If it's your first time watching, don't forget to subscribe to the channel and hit the bell to get notified on all of our future content. In today's video lesson, what we're going to be covering is buying a home with student loans. And the reason this is such an opportune topic right now is because recently the Biden administration has recalibrated these payments. So a lot of people that haven't paid their student loans for a very long time are now suddenly needing to start making those payments again. So it's at the top of everyone's mind. And unfortunately, student loans can have a major impact when you're going to buy a home. So what are the challenges that student loan borrowers face when they're buying a home? Well, it's really two main things. Number one is the amount of debt that you're carrying. Some of these student loans can be substantial, even some in the six figures. And the second thing is the future monthly payments that are going to be associated with that debt. So student loan debt counts against your repayment ability when you're getting a mortgage, even if those accounts are not being repaid. Even if the balance on your credit report is showing zero, we still have to count a payment against you when it comes to getting almost all of the mortgages that are out there. So that extra payment can change your affordability by a substantial amount. For some people, it may even make it so you can't qualify to buy a home at all, at least in a realistic price range. So those are the main challenges. Depending on the type of loan that you're getting, each loan type has a different way of looking at the student loan debt, specifically looking at the deferred payment or the monthly payment that they're going to be counting against you on that student loan. And it specifically is going to go against your DTI or your debt to income ratio on that mortgage. So all the loans calculate the repayment a little bit differently. So let's start out by talking about government loans. Government loans are going to be FHA, VA, and USDA loans. So FHA will use 0.5% or 0.5% for deferred loans, or they'll use the payment that's on your credit report. VA loans will use 5% of the balance divided by 12 months. So it's actually a much lower calculation than FHA. And VA will also allow for use of the income-based repayment if you have that set up, as long as it will continue for at least 12 months. So in some cases, the income-based repayment may be a lower payment than the actual 5% divided by 12 months. So you'll want to consider that. And on a USDA loan, they consider the payment on the credit as long as it's fixed, or similar to FHA, they'll use 0.5 or 0.5% of the outstanding balance to calculate what that future payment's going to be. Now, what about conventional loans? That's going to be Fannie Mae and Freddie Mac. So on Fannie Mae, they're going to use 1% of the outstanding balance to calculate that deferred student loan future payment, or they'll let you use that income-based repayment. Freddie Mac will use 0.5%, or the income-based repayment, or payment on the credit report or documentation. So you can see with each one of these loans, there's different criteria. There's different qualifications. So if you have a large amount of student loan debt, you might be much better off with one of those government loans, or for example, the Freddie Mac loan, than you would with one of the other programs like Fannie Mae that uses 1%. So this is something you should be discussing with your mortgage advisor on which one of these loan types is going to be the best for you, and maybe comparing FHA versus Fannie Mae and seeing where that's going to get you and how much more buying power you'll have if it's worthwhile to move forward with that different loan type based on your student loan debt. Now, the next thing that I want to discuss is default. This is something that's at a lot of people's minds right now because of the fact that they may have defaulted or had their student loans go into collections. Now they're trying to move forward with buying a home or refinancing, and they're having issues because their credit might be down, or they might just be having challenges overall. So when you're in default, there's very specific criteria that we need to adhere to because the loan is in a delinquent status. So if you're in default, it is possible to get a loan or a mortgage. However, we got to be careful with it. So you want to prepare ahead by getting your credit in place, a good down payment, and all your items in order. Typically, you're going to need to apply for a conventional loan instead of a government-backed loan because of the CAVERS system. The CAVERS system tracks people that have defaulted on government debt. So if you've defaulted on a student loan, for example, you'll likely not be allowed to get another government loan like FHA, VA, or USDA. I have had clients that have gotten government loans after a default, but it takes a lot longer because you need to get that account out of default and you need to get yourself off the Cavers alert system. The last client I had in that position, it took several months to do that. So it's not a fast and easy solution. But if you get with an advisor ahead of time, we can set you up a timeline and a game plan so that waiting a couple months to get all this stuff figured out while you're searching for a home is definitely feasible and it's part of the process. All right, so that's how we handle default. Now, co-sign loan. A lot of parents come to me saying that they co-signed a loan for their child or someone and now they want to go get a loan and wondering how that's going to affect them. So co-signed student loans are considered the exact same as if they're your student loan debt, just like they're your own loan. The only exception to that is if we can show that someone else makes the payments for at least 12 months. And if we can show that that was done out of someone else's personal bank account for at least 12 months, then we can exclude that debt from your debt to income ratio. Now, because a lot of these student loans are in deferment, there's not payments going on, it's a little bit easier said than done. But if you do have a student loan you co-sign, someone else has been making payments on for the last year, then it's definitely possible. We'll just want to discuss the documentation that's going to be required to prove that so we can move you to the next phase of the mortgage process. Now, the last item that I wanted to discuss with everyone is a common question that I get from new home buyers, which is, I've got this student loan debt. Should I pause and just stop paying the student loan debt so that I can save more money? Or should I stop saving money so I can pay off the student loan debt? It's really looking at it from a black and white standpoint. What I've advised my clients to do, which has been a really good solution to this, is to do a little bit of both. So make the minimum payments on your student loan debt while you're aggressively saving for your home purchase. Once your home purchase is complete and you own the property, then at that point you can shift gears to start aggressively paying down the student loan debt. The reason why is because you're not really going to get a lot of bang for your buck to pay off a student loan versus other debt. So you'd really be better off probably paying off a high rate credit card or an auto loan versus a student loan, just because of the amount of the payment versus the balance. So this is something you'll want to discuss with your mortgage advisor in depth to see how you should handle it for your scenario. But generally speaking, you want to do a little bit of both. So make that minimum on the student loan and aggressively save towards the home purchase, and then swap it and swivel back once the home purchase is complete. So I hope this little primer lesson on buying a home with student loans has given you some insight and confidence moving forward in the home buying and mortgage process. I do offer personalized one-on-one consults. I'm licensed in Connecticut, Massachusetts, and Florida, and you can reach me directly by call, text, or private message. 860-413-3938. I hope that helps, and we'll see you on the next episode. Take care.